In the first half of 2025, the US dollar suffered its worst performance since 1973, dropping by nearly 11%. And this isn't just about how the dollar stacks up against the euro. The dollar plays a much bigger role. It's the world's reserve currency, and when its value falls, so does global trust in it. At first, this may not sound like a huge deal, but remember, the dollar isn't just money used in the United States. It's a foundation of global trade and a benchmark for many investors around the world. So when the dollar loses value, it creates challenges not only for countries, but also for us, investors. Here is why. Imagine the dollar drops 11%. That directly cuts into your returns by the same amount. Nobody likes seeing their portfolio underperform just because of currency fluctuations, and it doesn't stop with investors. A weaker dollar also makes international trade more expensive. So in this video, I want to break down why the dollar is weakening so sharply, how this affects you, and what we can do to protect ourselves. Hi everyone, my name is Matthew, and today we are talking about the recent slide of the US dollar on the global markets. To start, let's remind ourselves what the dollar represents. It's not only the strongest currency out there, but also the primary reserve currency of the world. That means it's widely accepted across almost every country and is used as the main medium of exchange in the global trade. Central banks and governments hold massive amounts of US dollars as part of their reserves, just like they hold gold. For many countries, the dollar is considered the ultimate safe asset in time of uncertainty, and in places where the local currency constantly loses value, often because governments print too much money, the black market usually runs on dollars. For these economies, the dollar acts both as a store of value and as everyday money. Venezuela, Argentina, and other countries in Latin America are prime examples. So, the dollar isn't just a reserve currency. In unstable regions, it's literally a lifeline. But what triggered this 11% decline? The US dollar index, which measures the dollar against a basket of other major currencies, has collapsed to its lowest point since 2022. For context, at the end of 2024, $1 was worth 0.96 euros. Today, it buys only around 0.86 euros. In practice, that means €1 now costs $1.17 compared to $1.41 before. Everything from traveling abroad to importing goods has become more expensive. On the surface, Europeans might think, great, our euro is stronger, we get more dollars for the same money. But there is a flip side. If you buy stocks in euros that are listed in US dollars, the exchange rate works against you. If a stock falls 10% and the dollar loses 11% at the same time, your loss isn't 10%, it's over 21%. Many investors are feeling this right now. So why did this happen? To answer that, we need to rewind to 2024 when things were looking good. The US had one of the strongest post-pandemic recoveries in the world. Wall Street was optimistic after the election results, expecting new, business-friendly policies. Confidence was high, and the dollar kept climbing until the end of the year. But then came 2025 and chaos. It began with proposed tariffs from the US administration, which immediately rattled global markets. Some of them were only partially introduced, but others hit full force. The real tipping point came with trade tensions between the US and China. In February, the president announced 10% import tariffs on Chinese goods. By March, those tariffs doubled to 20%. Soon after, tariffs of Canada and Mexico reached 25%, though they were temporarily paused. Then, US-China tariffs skyrocketed to 145% on all imports, and China retaliated with 125% tariffs of its own. Now, yes, tariffs had been used during Trump's first term as well, but back then, the US was financially stronger, no pandemic aftermath, smaller debt, and massive fiscal support. This time, the backdrop is much worse. In May 2025, Moody's downgraded the US credit rating from AAA to AA1 due to growing debt concerns. That means the US is no longer viewed as the safest borrower in the world. Borrowing will be more expensive and paying down debt becomes harder. At the same time, the Senate passed Trump's Big Beautiful Bill, which increased the already massive national debt. Naturally, this hurts the dollar's credibility even more. On top of that, Trump has been in open conflict with the Federal Reserve, He's been publicly pressuring Fed Chair Jerome Powell to cut interest rates, arguing that lower rates would boost the economy. But Powell and other Fed officials refused. They argued that the risks were too high, especially since tariffs has already started pushing inflation higher. By July, inflation rose to 2.7%, above expectations. Core inflation, which the Fed tracks more closely, was also higher than forecasts. This situation puts double pressure on the dollar. First, markets now expect a higher chance of rate cuts, which makes saving in dollars less attractive. Second, Trump's attacks on Powell and speculation about replacing him created fears about the Fed's independence, and that independence is crucial. The Federal Reserve is supposed to set monetary policy without political interference. Independent central banks are better at controlling inflation because politicians rarely want to raise rates. One of the reasons the dollar is the world's reserve currency is precisely because of the trust in the Fed's independence. If Trump were to fire Powell or replace him with a purely political choice, that trust would collapse, and with it, the dollar's global standing. So what can we, as investors, do to manage this? Ultimately, returns depend not just on the performance of your assets, but also on the currency in which you earn them. If the dollar is falling, your returns shrink. If it strengthens, your returns grow. One way to protect yourself is to invest directly in the same currency the asset is traded in. For example, if stocks are listed in US dollars, buy them in dollars. That way, when you sell, you get the same currency back and eliminate exchange rate risk. Another option is to use hedged ETFs. These funds use financial contracts like futures, forwards, or swap to reduce currency risk. However, hedging isn't free. It comes with costs such as fees, interest rate differentials, and collateral requirements. So while hedged ETFs can be useful, they are not always necessary, and they can eat into your returns. Make sure you know whether your ETF is hedged before investing. The last and often more realistic strategy is patience. Market swings like this are normal. Every sharp decline has eventually stabilized. Looking at the 5-year chart, drops doesn't appear nearly as dramatic as they feel in the moment. In fact, the dollar was even weaker back in 2021 during the COVID pandemic, and if we zoomed out 40 years, the dollar fell much harder during the global financial crisis, losing over 37% from its heights. Back then, market crashes over 50% and panic was everywhere. Many companies went bankrupt. That's not what we are seeing now. The job market remains strong. Inflation is below 3%, and the Fed still has room to cut rates if needed. That gives them tools to stabilize dollar if another shock hits. So personally, I don't believe we are heading into a historic collapse. I expect the dollar to eventually bounce back. But now, I'd like to hear your thoughts. Are you noticing the impact of the weak dollar on your investments? Or are you brushing it off? Let me know in the comments below. Thank you so much for watching until the end. And if you'd like to discover some megatrend opportunities for a watchlist with massive upside potential, make sure to check out this video here. That's all for today. Enjoy your weekend and see you next time.